I think a silver lining of the trade war, it's galvanized Canada and Canadians and all stripes of government, all levels of government, to pursue the sort of projects and initiatives that are long overdue. The ones that you talk about, whether it's high-speed rail, it might be just another LNG port or an LNG facility, another pipeline to the West Coast, a pipeline across Canada, a deep water port in Churchill, Manitoba. The major projects office is going to be like a one-stop shop, help you. They're doing the initial seed financing, but they're trying to attract private investment. And that's where we have to see the execution play out. There will be some of those hurdles, what you identified, that may make it more challenging, but I think this time is different. And I'm really hopeful that we will see those long-standing projects, long overdue projects finally take place.
Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Hello, welcome to Colliers Talks Economics. I'm your host, Adam. I'm the National Head of Research at Colliers Canada, and I'm thrilled to be joined by Tony Stillo, who's the Director of Economics for Canada at Oxford Economics, a vendor we like and use quite a bit. Based in Toronto, Tony leads the national macro forecast. He provides analysis on data releases and produces research on the major forces influencing Canada's economy. And ages ago, we worked together in the Ontario Public Service. Prior to Oxford, Tony spent more than a decade at the Ontario Ministry of Finance, where he managed macro policy and modeling, and that gave him some deep insight into how the government decisions, which we'll surely talk about, shape economic outcomes. So today we're going to focus on Tony's perspective on the economy, what it means for real estate, the housing market, interest rates, and maybe talk a little bit about the uncertainty we're all dealing with in how do we forecast, what is the government doing, how is trade policy functioning. So this should inform the strategies for real estate owners, for investors and developers in the year ahead. So welcome, Tony. We're happy to have you.
I'm glad to be here. Thanks for the invitation.
Tony, we have a lot to talk about, a lot about the real estate market and interest rates, but let's start a little more high level. How do you do your work? How do we deal with the world today? So you've been forecasting for a long time, but I think it's fair to say forecasting has gotten a little more difficult in the last couple of years, or things have changed. I mean, we've had lockdown and school closures. We've had crazy geopolitical out of left field type things. We've had changes in inflation and interest rates that were sort of never supposed to happen. So can you talk to us at kind of a high level, like, is forecasting different now? Is it harder now? Is it the same toolbox? Like, how do you do what you do?
Well, the toolboxes have grown. They've become more readily available basically anytime, anywhere, and at a cheaper cost. We have a lot more tools in our toolbox. So that's great. But the future's always been uncertain. The world's always been volatile. What we've seen, though, in the past, say, several years, definitely since the pandemic, is a heightened level of uncertainty that I haven't experienced in my career. Now, you may go back to the Depression and World Wars and talk about uncertain times, but what in my career, in the past, a few decades, I'll call it, this is the most uncertainty I've had to work with. And it makes our job tougher, for sure. It's humbling. But I'll just say, you still have to produce forecasts of what you think is most likely to happen with a spectrum of risks that you identify. And that's what we do a lot at Oxford. Decision makers have to make decisions today in that uncertain world. So the idea is you may not have an explicit forecast, you have an implicit one. It's always better to work with an actual forecast that you can say, here's what we were planning based on. Here's something that's changed. So we have contingencies in that regard.
Fair enough. And yeah, I think it's a good point that it's really the golden age of data. I mean, compared to what we were contending with even 10 or 15 years ago, it's amazing what's at our fingertips. But at the same time, the challenge seems to be a bit greater. I mean, if you had told me a couple of years ago that we'd have 12 interest rate hikes and then 9 interest rate cuts, I mean, that doesn't happen, but we're trying to contend with it now. Okay, so we rely on Oxford for forecasts of what's inflation going to be in Q1 2028. But, can we really pinpoint that these days? Like, I think in the past, that was a realistic thing to do, to say 2 or 3 years out, we're going to forecast what's growth, what's the labor market, what's inflation. But now when you're trying, you guys are trying to look 3 years out, 5 years out.
We go a lot farther than that too.
Right. I mean, like how do you balance, like, you need to pin a number down, but like the uncertainty range is just getting huge, right? It could be anything.
I use a baseball analogy. We're always trying to throw the ball down the middle of the plate. Our most likely path for the economy moving forward, we have a really rigorous approach to doing it. We have model-based forecasts. We have a lot of tools that we talked about a moment ago, and we think we can put out a forecast that we say, this is what we think is the most likely path. That being said, when the band of uncertainty, even in the near term, is so wide, usually you forecast the near term is a little bit more certain, and the further out you go, that confidence band widens. But what we've seen in the past, several years, is great uncertainty in the near term. Look at what we're dealing with today. We have a president of the United States that's upsetting the longstanding trading framework globally. And so we're moving, we think, into a different world. Prime Minister Carney laid it out really well in his Davos speech. The world order that we've been working with for decades is gone. And we're moving towards probably a more fractured world with strategic protectionism and regional trading blocks. And that's a very different thing. It may be fine in the long term. We all have higher costs, but the idea is moving from here to there is really disruptive.
Yeah, and let's tie this to real estate a little bit. So we are a sort of slow-moving, long-term type of industry. It is not a date. This is not foreign exchange or bonds or the stock market where you buy one day and sell the next. It's a long-term type of thing to develop. Even to as an owner, you're usually looking at 5, 7, 10-year time horizon minimum. So it's much more challenging. In other markets, okay, something changes in trade policy, we can react, and we can sell this and buy gold and do whatever. But real estate, it's much longer term. So downside risk, upside risk, when the range of outcomes is so wide like it is now, how do we incorporate that? This is a pretty broad question, but in a real estate industry where we're often looking 10 years down the road, like, the world could be unimaginably different then. Like, how do we build that into underwriting, forecasting, looking? We have to have some realistic view of what are rents going to be, what's the labor market going to be in that time. But how can we do that now?
Well, at Oxford, we do produce alternative scenarios. We put a subjective probability on those. And what I'd say is, when you're making decisions, you look at our baseline forecast, I call the most likely scenario, and you say, you know what, I think Oxford's a little too optimistic. You can look at our downside scenarios, incorporate that, and plan accordingly. And so, for example, let's take a specific example for office and commercial real estate. So you say, we had during the pandemic a lot of individuals working remotely from home. Now there's mandates to bring people back into the office full time. That could change the equation for your decision making on commercial real estate investments. Now, I think the happy middle is going to be where we end up, this kind of pendulum swinging back to having everyone back in the office. Some of those offices don't even have the footprint to bring all their workers back. There was a balance between home life and work life that I think works. So I think we'll go back to there. So that's what we would have in our baseline view. Again, then when you're making a decision in the commercial real estate space, you would say, I agree with that. Or no, I think everyone's going to go back to the office in downtown centers, and we're going to see the office sector booming again. So what we try to do is give enough information, what we think in our most likely scenario and our alternatives, so decision makers can be informed when they make their plans. And like, I use a lot of analogies for, what if you're going to go, I'm giving a forecast for the weather and you want to go sailing. I give you, well, I think it's going to be sunny and breezy. It turns out to be, but I said, you know what, there's a chance of rain. Bring a jacket. Well, when you go out sailing, if it's all of a sudden sunny, not so sunny, and it's rainy, breezy, but still good sailing, your plans are followed through, but you brought that contingency, a jacket. So think of that in the kind of real world applications for different lines of business. And when they're trying to adapt to changing environments, as you said, things do change quite rapidly these days, it seems.
Yeah, they do. And we're contending with that. So let me put you on the spot a little. Return to office is obviously a huge one, but we've seen these huge, unprecedented kind of shifts in a lot of areas of real estate. So e-commerce growth, return to office, huge demographic growth driving the housing market. Like, which of those, you mentioned some of these are just going to normalize, and maybe we'll just kind of go back to the median or the compromise. But what's a big structural shift that's here to stay, that isn't going back to where we were 5, 6, 10 years ago?
I think globally, there's three structural shifts that we've talked about. One is this strategic protectionism, moving from a global trading order to a regional and fractured one. That is underway. And so you'll see trading blocks. You won't maybe see the sort of trading relations we had with the US. Will still be predominant for us because they're just too big a market, but we're trying to diversify. And so that's happening across the world. The AI investment super cycle is also at play. Now, that is something we still have to see how it plays out, but that could be transformative. And lastly, fiscal activism. Most governments now, Canada included, are taking a more proactive approach to supporting their economy, directing their economy. You think about in Canada, we want to build east-west corridors. We want to have infrastructure. We want to have diversifying our trade. And so there's that part of it. Then you have long-standing issues like an aging population and climate change. But I'll get to some specific for Canada that we see in the coming year. One, more than most other countries, the whatever happens to the economy hinges heavily on the USMCA renegotiation. And we can talk about that in more detail later, and we've got quite a lot to say about that. Then you've got the fiscal side. There's a pro-growth policy. The government today is February 5th or 6th, the Prime Minister Carney released a new auto strategy. So we'll be taking a look at that, trying to develop redevelop our auto sector. And then you've got monetary policy, which we think is largely going to be on the sidelines this year. We think most of the heavy lifting is going to be from the fiscal side. And then you've got a demographic shift, going back to what you started with. That I don't think is long-standing, but we are going to do a reset from a surging population growth, unsustainable growth in temporary residents, 23, 24, to now a slightly shrinking population. That is kind of the undercurrent for your business for a while. That being said, that's a couple of years, and it's a major departure from where we've been. And then we're expecting immigration flows to resume, but within the capacity for the Canadian economy to absorb them, both for infrastructure and other aspects. And I have one other last thing, and I'll turn it over to you, though. Go ahead.
No, I think the one surprise for us is when you're looking at, again, long-term forecasting, underwriting, demographics isn't usually where you expect a ton of volatility. Like exactly. Demographics is the thing where, look, you can project it out pretty reliably 5, 10, 20 years just based on what's the birth rate and what's the current population. And so what we've gone through, again, like everything else in the last 5 years, you don't normally have the yo-yo of population growth quadruples and then goes to 0 12 months later. Like that just never happens. And that's certainly wreaking havoc in our world of, okay, huge population growth, obviously housing, huge need, we're going to build more. And then the rug gets pulled 12 months later, and everyone's sitting here saying, now, wait a minute, these projects take a while to build. And I had built in some maybe aggressive assumptions about rent growth, about population growth, about demand, about occupancy. So yeah, I think it's one of the things that's so unprecedented for us. Yes, there's Trump and USMCA and everything, but the idea that demographics fluctuate like this just, I'm not sure there's any precedent for that. You can say you can look back 50 or 100 years for some of these things, maybe tariffs, but demographics yo-yoing like this is just really causing us a lot of trouble.
Aside the restrictions during the pandemic, we've never seen Canada's population decline since Confederation. So you're absolutely correct. It's usually a rock that you have foundationally to your planning for longer term, and you say, okay, maybe there are little wiggles around that. The business cycle may affect the economy, but that is the rock. And actually, it's swung significantly up and down. You're absolutely correct. And I'll go to a specific aspect of the government's attempt to reduce the share of temporary residents share of the population to 5% from its current 7% range. Most of that is going to be students. Where it affects your line of business is when you have a student housing, whether it's multi-unit dwellings for student housing. That had an abrupt change, and it's going to vary across the country. It's going to be those second-tier post-secondary institutions that are most heavily hit. So that's where I give you a little color to say that's where it's happening in the near term. Then when we get to a steady state of resuming population growth, you'll be able to have longer-term planning that I think you can rely on, not from the demographic side.
Yeah, I would imagine that would have to come back to you talk about things coming back to an equilibrium, like demographics is an area where surely zero population growth is not the plan long term. Like
Well, without immigration, we would see a
natural.
natural decline.
But I'm just saying, like long term, there will be immigration.
Yeah.
There will be a change in immigration policy. I believe your forecast is maybe like we're 2 years out from that, from like growth coming back.
That's right.
So it's certainly not permanent. Okay, lot to discuss here. Infrastructure. There's been a lot of talk, and I think like I give the government credit for saying like we need to make some of these big projects happen again. You and I were at the Ontario Public Service long ago, and I always say to people, I remember all of these same. I remember the Ring of Fire and high-speed rail to Quebec City and expanding ports. All of this was there, but it's complicated and it's expensive and it takes a long time. And honestly, it upsets a lot of people because we might need to expropriate land or have a bigger deficit, or there's problems.
There are
that
real
come with
hurdles, is the bottom line.
Yeah. So, but there's obviously some momentum here from the federal level, which maybe there hasn't been in the past. So, does this feel different? You've done this a long time and you've worked in the government, but does this feel different to you? There's more seriousness. There's more money behind it. There's more momentum to make this happen.
I think a silver lining of the trade war, it's galvanized Canada and Canadians and all stripes of government, all levels of government, to pursue the sort of projects and initiatives that are long overdue. The ones that you talk about, whether it's high-speed rail, it might be just another LNG port, or an LNG facility, another pipeline to the West Coast, a pipeline across Canada, a deep water port in Churchill, Manitoba. A variety of these things are they're attempting to do them all, but the government isn't spending on that. The major projects office is going to be like a one-stop shop, help you. They're doing the initial seed financing, but they're trying to attract private investment. And that's where we have to see the execution play out. And there will be some of those hurdles you talked about, you identified a few that may make it more challenging. But I think this time is different. There'll always be trepidation on some projects and specific unique ones in different parts of the country. But I think that this time is different. I'm really hopeful that we will see those long-standing projects, long overdue projects finally take place. Again, they'll still take years, but the major projects office intent is to have things done quickly and expedite that approval process compared to the sort of multi-year experience in the past.
Yeah, I think there's clearly some improvement happening there. Now, to pull it to our sector, and we've discussed this with previous guests. This is great. We're finally getting serious. We're building big projects. Now, hold on. There's only so many employees. And we're already in a situation in real estate where a lot of the constraints are around labor. Like there just isn't enough in terms of trades or construction labor. So I'm not sure that building a bunch of major projects that take 20 years is going to help that situation. Like, is there a concern here that like this big focus on infrastructure, which often is in these kind of remote areas, right? Like Ring of Fire or Churchill, is that going to impact the labor market? Because we're struggling with high costs. A big part of high costs is a tight labor market, an aging labor market. And this seems honestly poised to make it worse, potentially.
There's a risk of that. We're hoping that they can pursue more productive approaches to a lot of these projects that are going to require fewer workers, whether it's AI informed or not. One thing that the higher cost of labor does is it should incent firms to choose capital labor saving approaches to things. And that's not just in the construction sector. It could be broader, where you're talking about the construction sector. And I'll just dive into one area where we have a different view than the federal government. On the housing file, their goal to double the pace of construction, we think is too much. We've done some analysis. We think it's going to be higher than we are today. But let's say we'll crest in the high 200,000 per year units range across Canada, closer to 300,000, not 500,000. We think that would be too much in housing. That's one of the concerns we have, that we've invested too much in housing at the expense of other more productive investments in capital and R&D and things of that nature. And so we think our numbers are feasible. They're within the capacity. They wouldn't strain from the housing side. The other sectors, there could be issues, but I think that those can also be beneficial. They can benefit by different approaches to make them less labor intensive. Hopefully that will mitigate some of the problem, but you're right, there is a risk there.
Okay. Now, speaking of things we've been discussing forever, since as long as you've been doing this, we are going to internal free trade. We're going to break the barriers and free up things, and we're just going to get sort of free growth by doing this. So why is that so difficult to, like, is that even a realistic goal? And why is that so difficult? Because we have this discussion every 5 or 10 years, and this is it. This time we're serious. And we've seen, okay, there is momentum on the infrastructure major project side, but the internal barriers, labor mobility within the country, like, do you see that as something that can be realistically addressed and that would have big benefits?
I think we'll liberalize it compared to what we have now, but I don't know if it'll be complete free trade in goods and people across borders. You will see the reason why we always had difficulty in the past, because local politicians, whether they be provincial or even a sub-provincial level, will want to protect their local industries. You still can't see spirits across, like wine and liquor, across borders. And that's when you do free trade, that's where you get the benefit of that. You get the competition driving lower costs, better quality of product and all that. But there are winners and there are losers. And I think that there'll always be that problem of some jurisdictions trying to protect their economies. That being said, there has already been a lot of significant movement to liberalize trade. The IMF came out with a study. I think their numbers are a little richer than I would estimate it. We'd get a benefit to the economy about 7% in the long run. That's quite high. Actually, the federal government came out with another report, and they're kind of overlapping it, I think, on if we made our economy more competitive and deal with regulatory issues that make, we have oligopolies and things that aren't as competitive, that would add 10% to our economy. I think there's overlap in those two figures, and they're probably on the high side. That being said, it will benefit the economy in the long run, but we have to get through. Anytime you change the rules of the game, there will be winners and there'll be losers, and that's what I think we're trying to deal with, that transition. And there's some resistance in some pockets.
Yeah, I mean, 10% sounds wonderful, but also maybe a little optimistic.
I think it is. Yeah, I haven't looked at it in detail. I'd have to dig into the details, but I think it's on the high side. My gut tells me that.
Sort of related topic, and we just had a whole other podcast on the productivity topic, which has been talked to death. But you've commented publicly that creating jobs and productivity are not the same thing. In fact, they're almost opposed to each other, and we seem to be holding steady on the creating jobs, but the productivity thing, we never quite get there. So why is that? And why does it matter, if you want to editorialize on that?
Well, it matters. I'll get to that first, because that is what's the basis of a higher standard of living. We get more productive, we get higher real wages, higher earnings for companies, and we all do better with the same inputs. So that is the foundation of why productivity is so important to our welfare in the future. Now, growth policies have leaned on immigration as a source of labor, so that labor supply was basically more readily available to firms than investing in capital. And we've seen that happen. We also in Canada have smaller businesses that basically don't have the size to take the risk to invest in capital. That's that issue of our small and medium-sized enterprises, which forms the bulk of our economy, are just not of that scale. So there's a number of factors that have kind of made the equation for Canada lean towards hiring more workers rather than investing in capital. And we're hopeful this year, if we get a resolution of some of the uncertainty, which is hanging heavy on CapEx by businesses in Canada and elsewhere, and hiring, but basically on the CapEx side, that we can see an inflection point in the coming year, that we could see a turnaround in business investment. We've done analysis of the finances. They have the financial side of it is basically there for them, so that it's just they've got to have the willingness to invest. The ability, we think, is there.
Okay. And to tie this all together, so we started with infrastructure investment and also the external shocks we're contending with. And you have looked into this deeply. It's going to reduce GDP by this amount, and it's going to increase unemployment by this amount. So are these improvements we're talking about, trade diversification, internal trade barriers, infrastructure investment, is that going to be enough to offset what's happening at the bigger global level? Or is it enough to break even? Are we still going to be like negatively impacted? What's your kind of coherent view on that?
We'll see how coherent it is, but our view is in the near term that it can't offset it. It's just going to take time. And so that I talked about, even if we move to more regional trade blocks that Prime Minister Carney is pursuing with other nations, those will all take time. Internal free trade, reducing regulation, all those things, the infrastructure projects, they will benefit us. And we think we will see the benefit, but it'll take years. And so in the near term, the next couple of years, we're dealing with a disruption from basically the trade war initiated by U.S. President Trump.
Yeah, unfortunately, I think that's accurate. Okay, let's talk about real estate specifically, and our favorite topic in interest rates in the real estate world. And it's been like I often say, every chart we look at for the COVID period looks the same. It goes down to record lows, it goes up to record highs, and then it sort of settles back down, whether it's the labor market or immigration or growth or anything else, to a sort of normal level. But I think there was some expectation that the normal level for interest rates was going to be lower than this. Like, we're at 2.25%, but I think you've talked about perhaps there aren't going to be any more cuts. Perhaps there are even going to be hikes. And I would love to hear you elaborate on that. Like, what is driving that outlook? And we are obviously a very capital intensive, debt reliant sector. So this is hugely important, much more so than it is on a lot of other industries. So interest rates is really at the crux of things. I think there was a feeling it was going to be a tailwind maybe in the next couple of years, but now it's stalled out a little. Why is that? Why is there a hesitation to cut further?
Well, I think there is a modest tailwind from that. Our estimate is that the current 2.25% policy rate is slightly stimulative. Our neutral rate estimate is 2.75%, the midpoint of where the bank has it. So we think it's an appropriate level. I think the Bank of Canada is also cognizant of what they might have dealt with post-pandemic. So they had cut interest rates to historic lows, and then you saw the supply side and all the things post-pandemic that led to a surge in inflation, and then they hiked aggressively. And I think they don't want to yo-yo that forecast. So our view is that they're probably on hold, and it's contingent on the trade deal, which is the biggest headwind that's facing us, the uncertainty and the tariff effects alone. Now, at 2.25%, you talked about the tailwinds ending. They take a year and a half to flow through. So we're going to get this modest stimulus from the lower short end rates for the next year and a half or so. Our view is, assuming a successful renegotiation of the trade deal with the U.S., the North American trade deal, the USMCA, we will start to see an uplift in growth in the second half of this year, leading into next year on the trade front. We also have the fiscal stimulus coming from the 2025 federal budget and other provincial governments, which is largely capital based. Now, they just introduced a new grocery and essentials benefit, which is going to bump up growth, we think, in the second and third quarter. But most of the fiscal stimulus is going to hit later in the year. The Bank of Canada knows that too. So they have to be cognizant of the stimulus all in coming to the economy. So I think that they're likely to stay in this neutral or slightly stimulative territory for the rest of this year. Now, where we see them hiking is, again, a prerequisite is we start to see the economy improving, not just domestically from the fiscal, but also from the trade side, that we would see them return rates to a neutral level. I'm not talking about hiking, not a sustained monetary policy tightening cycle, but going back to 2.75%. If there's no trade deal and we keep the status quo, we've done some scenarios, like if the current tariffs remain, you'll see those rates stay at 2.25% longer, well into 2027. If we actually have the trade deal die and we get into a much more dark scenario where we think it would push the Canadian economy into a recession later this year, then you'd see them drop rates into the single digits.
Okay. And I should let you elaborate a little more on NAFTA or USMCA or CUSMA or whatever we call it now. But I'm afraid perhaps I missed that in the outline, but I mean, this is a huge factor. It sounds like you're modestly optimistic about this. It's just too drastic to throw the baby out with the bathwater. Like this is looming. It goes back and forth day to day in the news cycle. We said this, we said that, but wait, like big picture, what is your view that it's just going to arrive at a compromise? We're going to kick the can and keep the status quo. What's going to happen?
We actually produced scenarios just a month ago, precisely because of the uncertainty in this regard. What we've held for a long time is that we would see the deal renegotiated, though the current tariff rates between Canada, the US, and not just focus on those, but North America wide, would be reduced. Not to where they were pre-Trump. There'd still be tariffs on metals like steel and aluminum by the U.S. on us. They see that strategically as one thing they want to have domestic capacity for, so they're going to maintain tariffs there, we think, and some of our agricultural products, which they have another grievance with. And that would be something around the middle of the year. We'd see that. That's our baseline. It's been that for a long time. We've been concerned that the alternative scenario of these current tariff rates, which are much higher, will be indefinitely maintained until all the grievances are resolved. And that's what we've done in an alternative scenario, saying, what if our baseline, which is cautiously optimistic of a trade deal that lowers tariffs, not to pre-Trump levels, but lower than they're today, what if that doesn't come to pass? What's most likely the next down leg on it? And we think it's current tariff levels indefinitely remaining. And that, we don't think that'll cause a recession in Canada, because we have some other kind of underpins to growth, some tailwinds, modest or whatever. But the idea is that they are going to support a slightly improving economy later next year, but we'll muddle through. We won't get strong growth. And like I said, the worst case scenario is where we actually see the trade deal die. And then we get a real disruptive structural adjustment period where we have a contraction in the economy, we think, later this year.
Mm. Okay, now let me go back to the interest rates, borrowing costs. We're not completely on our own here. Like, how much of borrowing costs being pushed up is us and our spending and our approach and our policy rate versus just what's happening globally? We have a large deficit. The U.S. has an even larger deficit. We have inflation. The U.S. has even more inflation. And that tends to have an outsized effect. So we've already diverged on the policy rate more than we normally do. And yet you still see rates rise because of what's happening potentially globally.
Long rates.
Yeah. And the actual borrowing costs versus the target, like the target rate. One challenge for us is that the target rate has gone up and down wildly. And the actual borrowing cost, if you're looking at like a 10-year bond, hasn't really changed much from 6 months or 2 years ago. It's been in this range and hasn't moved dramatically, even with 10 hikes and 6 cuts and back and forth. So, is this just being driven by global factors? Like, Canada's not a huge significant player in the global economy. It's maybe a couple percent. Or is this just the looming impact of the U.S. having huge deficits and high inflation, and we have to contend with that?
It's both. So our view is that the short end, I just walk you through how we baseline most likely scenario is going to stay flat the rest of the year, tick up to actually neutral. On the long end, so 10-year bonds, for example, we think our rates are on a trajectory to rise. And we typically, have a small gap slightly below the U.S. rates. We have a significant spread between that's about 70 basis points in the latest quarter or so. And we think that's going to return to its historic gap of about 15 to 20 basis points. And the reason for that is we are tied to the U.S. on our rates. You mentioned it, especially at the long end. That is the kind of the core rate our benchmark rate that we key off of. And their rates are rising and our rates are rising because of global factors too. Term premium are up, risks of inflation volatility, fiscal sustainability. And you mentioned it. It's not just in the U.S., it's in Canada too. So the U.S., we think, are going to maintain their high rates, and we're going to close our spread to them. And so unfortunately, it means even though the short end is going to stay relatively stable, we'll call it our forecast being unchanged, but the long end is going to trend up. And that is because the highly leveraged nature of the business you're in, a huge factor.
Well, yeah, let me follow up on that, which is you're talking about higher rates, or at least certainly not lower rates and the borrowing costs. But we're facing, as we read every day in the paper, housing affordability, housing development is a huge issue. It's impacting the entire rest of the economy. It's impacting family formation. It's impacting migration within the country. It doesn't sound like higher rates are going to help with housing affordability, housing development, housing investment. Like, what's the outlook? Like, sure, the federal government has some plans to make improvements here, but it's largely driven by market forces. And I guess I'm feeling a little more pessimistic about the housing side of this. If you're saying like rates are just going to be sort of gradually pushed up, that isn't going to help housing investment or housing development in the short term, right?
Well, that is a much messier story on the housing, because we do have a chronic shortage of housing. Yeah, we have an unaffordable housing sector, broadly speaking. Let's talk about nationwide. I know it varies across the country. Really an issue mainly in Ontario and Southern Ontario and BC. We think the housing market is going to slide a little further. It's not going to bottom out until we get some of the resolution of these uncertain factors. And we also, on the trade side, job security, income security, things of that nature. And we also think that there's some modest layoffs coming. GM just eliminated one of their shifts in Oshawa last week, and we have Stellantis moving some of their production to the U.S. So we think some of those are anecdotes, but we think there's some modest layoffs to come. So in the near term, we think the housing market still has to find its bottom. That being said, we're looking for, again, with some of these factors that are turning around an overall economy, we're looking for things to improve next year. And it isn't just interest rates. We do have a shortage of supply, and interest rates move in both ways. They'll lower the cost for the builder and the buyer, and sometimes they get capitalized in higher prices too. So what we need more supply. As I mentioned earlier, we think there's a lot of efforts by government across the country at all levels and the private sector to boost housing supply. And we're looking for that improvement in new home building over the medium term. That'll have supply grow faster than demand. On the demand side, we have the lower immigration, the reduction in temporary residence side that actually lessens the underlying demand for housing. So when we look at those in a holistic way, we see that the market taking roughly a decade, the housing market nationally, to rebalance. So it's not a short-term fix, it's a long-term fix, and it's multifaceted, not just interest rates.
Okay, fair enough. And give us a little more color on the housing market. It's an evergreen topic. Everyone is interested.
And stable demand for housing.
Well, but you say that, but the condo market is
research.
Yes, well, yeah, for discussion of it anyway. So big picture impressions, like the condo market is obviously way, way down. We're reading about like record low type sales. But again, there's a long-term nature of this where I've heard the bull case here, which is, okay, we're going to slam the brakes on building. There's going to be nothing built. And at the same time, we're going to see improving demographics and everything. And 5 years down the road, this is going to be completely flipped upside down. We're going to say we don't have enough housing. We need to start building condos faster. So like, what's an indicator or some kind of metric you're kind of keeping your eye on in the housing market? We've talked about rates, we've talked about demographics, we've talked about labor in that area. What else is on your mind there?
I'll go to the condo just because we spoke to it, and it's mainly a GTA phenomenon. This condo conundrum, and what I see it as, it was investor purchased houses, condos, shoeboxes in the sky to really pin it down. Too small, not what is in demand today. So the idea is that cohort that they were building for, young people without kids. Well, now that cohort is aged and they're looking for not a bachelor or one bedroom, they want multi-bedroom units, even if it's a condo, let alone the picket fence in front of a single detached home. And so I think there's a mismatch. And what has to give right now is prices, and they are. Prices have to come down. So those investors, unfortunately, some of them who bought at later stages are probably going to have to take a bit of a cut. Now, I'm hopeful for this. I've talked about this before, and I've talked to some in the building industry. I think there's potential at some point to turn single units into double units by renovating them. So when the price point gets to a certain threshold, a lower one here, I think it'll be a feasible option. And you'll see some of those units, and I think it's happened in small ways across the country. But I think that's the hopeful part. We just don't have the right mix. So even though there's an excess demand and shortage of supply, what we have in Toronto is the wrong supply. And that's why I think there's a conundrum here for the condo market in particular. Now I can go back to your other questions, but if you can bring me back to what you wanted to focus on housing, you talk about other indicators. We track a whole host of them.
Yeah, I think fair enough. One more question that I think maybe we didn't outline, but I'm always curious. The job market is obviously key for our industry as well. Both, like you mentioned, layoffs, the housing market, just the general confidence side. But again, it's one more area where we've seen the yo-yo, right?
Yeah.
Unemployment goes up to record high, then it goes down to record low. And now we find ourselves, I guess, back at a sort of normal-ish labor market. But that seems to be...
I would argue we're in a slack in labor market.
Well, a slack labor market. I'm glad you say that, because there's certainly some discussion of return to office being rather tied to a weak labor market. Like, nobody was talking about return to office 4 years ago when we had record low unemployment and, hybrid work was the norm. The weaker the economy gets, the more momentum there is behind return to office. Is that a little reductive, or do you think it's fair to say that, like, the job market, especially the sort of downtown professional job market, white collar is kind of an archaic term, but whatever we call it, the professional services, FIRE type worlds, is return to
finance, insurance, and real estate when you say FIRE?
Yes, FIRE, the acronym we use. But is the labor market driving the return to office momentum that we're seeing? Do you see the connection there between, like, a weak job market and there's always a balance between employers and employees, and there was a sort of unusual situation where the employees had a lot of leverage, maybe more than they ever had. And that's just sort of swinging back to a bit more of like the normal balance where the employer has a bit more leverage here.
It could be. I think it's swung a little past where I think it's going to end up. I mentioned that at the outset. And there's also political leaders. Premier of Ontario is trying to get people back into the offices, both in the government sector and in the private sector here. It helps not just the office sector, but he's thinking about all those businesses that are underneath our office towers here in downtown Toronto, where they have, shops and restaurants and things of that nature. But what happened when people were working remote, you saw those sort of businesses thrive in other parts. I come from Lancaster, and in Hamilton, there's a lot of remote workers that come into the office to Toronto 2 or 3 days a week, but they've kind of supported industries out there. So I don't think it's purely who's got the high ground in terms of the state of the labor market. There's other forces at play. And so you're talking cyclical, I'm talking about an actual policy to create and more structural. In terms of the labor market where it is now, what we think, and there's another structural element to that I'll get to in a minute, is the AI impact on office employees. We've done some work on that, and that could be one of the areas that's most affected of all sectors and all occupations. But what we have going on is a labor market that we think is being affected by the trade war. And I'll tell you, there's two sources of labor market data that I would advise all the people that are in commercial real estate to look at. Not just the regularly reported household survey, the labor force survey, which comes out tomorrow for January, but it's a survey of employment earnings and hours. That's the payroll data, which is, in our opinion, more well-grounded. But it comes out with a 2-month lag, and it gets very little attention. Those show very different stories on the labor market. One, the household survey is showing much stronger growth, like upwards of 1% and change. I can't remember the latest numbers that are comparable to the period for the payroll survey. The payroll survey is only up slightly. And I would look to both of those surveys to try to get a beat on what's going on. We tend to lean to, we have to report on the household survey. It comes out in such a timely manner, and that's what gets all the media attention. But it is diverged in a significant way from the payroll survey. And we're going to do an actual research piece on that. I'll just pitch it now, come out in the next week or two to talk about how we think that the payroll survey is a better guide. Now, all that being said, the labor market is still slack. We expect some modest layoffs now. We see the unemployment rate rising slightly, but not staying there for long. And that's what's key. If you so you have to look at other measures of slack in the labor market beyond the unemployment rate, because the participation rates change. I would look at prime age employment to population metrics, things of that nature that kind of abstract from the part rate. But what we're still expecting is the population to decline, so the labor supply to decline, and you're going to see the break-even level of employment. You can even see declines in the unemployment rate in jobs, and the unemployment rate will stay flat or fall because we're going to have a shrinking labor supply as the government undertakes this demographic shift to a lower share of the population for temporary residents. That is the next year to 2 years.
That's an interesting point. Moving the denominator down has an effect on things.
Yeah. And from the size of the economy, the demand, it moves both the demand and the supply side. And that's why we think the Bank of Canada is well aware of that. And we're going to be watching that closely as well.
Okay. So last question. Looking ahead, first half of the year, what should I be keeping my eye on as someone in real estate? What are the data points? What's the latest inflation level? What's the export level? What's the change? You mentioned like different household surveys, housing starts. Like what's a data point, maybe one we haven't talked about that you've we in the real estate world, in the development world, financing world, that we should be locked in on?
Well, I think you just hit them all, but I'll go through them. So I'd look at GDP in the sectors that matter to you. Think of the industrial sector. You look at manufacturing, transportation, warehousing, retail, and wholesale. Those are the ones that matter to industrial. You look at employment growth in those sectors for industrial, but you also look at employment growth in the office sectors and more of the service sectors, things that matter to you. I would look at interest rates and see what's happening, see if the view that I've laid out is playing out, because those are so critically important to you. And then inflation, because that's your cost escalator. So you look at factors like that. And then what's the undercurrent to all of this is what I told you was the hinge factor, is what's going on with these trade negotiations, because those are going to be pivotal to Canada's economic prospects in the coming year.
Excellent. Thank you, Tony, for joining us. Thank you for all the insights on the economic outlook, the forces shaping investment, the real estate market. It's been a real pleasure to have you. Thank you to everyone for listening or watching this latest episode of Colliers Talks Economics. We really appreciate your time. We hope today's conversation was practical, interesting, and something you can apply to your decision making. So be sure to join us next time for more insights and conversations. Thank you.
Thank you.
Thanks for listening to Colliers Talks Podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.